Elon Musk oversees a sprawling collection of companies. You have an electric automaker, a rocket manufacturer, an artificial intelligence startup, a social media platform, and a tunneling venture, all operating in entirely different industries. Legally, a strict boundary is supposed to exist between them. Tesla is a publicly traded company, directly accountable to millions of shareholders. The rest are privately held, closely controlled domains where Musk holds near total authority. On April 30, 2026, Tesla submitted an amended 10-K/A to the SEC. This document provides a detailed account of how Musk's corporate empire trades with itself. The filing reveals a highly porous boundary. Hundreds of millions of dollars in cash and massive equity stakes are flowing freely back and forth between the public automaker and Musk's private ventures. For public shareholders, this creates a significant oversight blind spot. Musk's personal, private interests are now directly intersecting with public capital, with almost zero friction. Let's look at the cash flowing into Tesla. The filing disclosed an enormous $573.4 million in related party revenue for fiscal year 2025. The bulk of that cash came from xAI. The artificial intelligence startup spent $430.1 million purchasing these exact Tesla Megapack energy storage units to power their data centers. The remaining $143.3 million came from SpaceX. This injection of cash was largely tied to vehicle sales, likely a bulk order of Cybertrucks to prop up a struggling consumer unit. On paper, this looks like a massive win for Tesla. Finding large, paying customers inside your own ecosystem is an incredibly efficient way to validate product lines at scale. However, these transactions establish a precedent where a publicly traded company relies on its CEO's private network to reach its own sales targets. The exchange of capital moves in the opposite direction as well, with Tesla paying out millions to Musk's private entities. Last year, Tesla paid $11.4 million to SpaceX and $4 million to xAI for commercial and consulting services. Add in payments to X, the Boring Company, and Musk's personal security, and total expenses to affiliated entities reached $24.8 million. The pace is accelerating. Through February 2026 alone, another $78.1 million moved through this exact network. What we are looking at is essentially a closed-loop economy. Public shareholder capital is being continuously recycled through privately controlled vendors. The cash ledgers are only half the story. The most consequential item buried in the SEC filing involves a massive deployment of equity. In January 2026, Tesla shareholders authorized a $2 billion investment into xAI's Series E funding round. They voted to back an artificial intelligence company. Weeks later, SpaceX suddenly acquired xAI holdings in a corporate mega-deal, and as a result of the acquisition, Tesla's preferred AI stock was quietly converted into SpaceX Class A common stock. This meant a multi-billion-dollar pivot from an artificial intelligence startup to a private rocket company occurred without a single additional shareholder vote. This transaction bypassed standard corporate consent entirely. Public investors who wanted exposure to AI are now forced to hold minority stakes in a private space venture, regardless of their original mandate. These legal disclosures confirm that the functional separation between Musk's various companies has effectively vanished. The structural crisis here is simple. Because Musk controls both sides of every agreement, there is no independent party to verify pricing, negotiate terms, or enforce boundaries. Moving forward, this opens up massive regulatory risk. Institutional shareholders are beginning to scrutinize exactly how their capital is deployed across this private chessboard, which leaves the market with a defining question for 2026. Is this deeply integrated ecosystem a brilliant strategic advantage, or the most significant unchecked conflict of interest in modern public markets?